Welcome back to The Explainer. Today, we're tracking the massive, highly interconnected ripple effects of what is easily expected to be the biggest capital event of 2026. We are looking at a move so colossal, it's literally redrawing supply chains across entire continents, funneling billions into brand new technologies, and sparking a fierce, high-stakes debate right in the middle of Wall Street.
All right, so here's our roadmap for today. Number 1, the 2 trillion empire. Number 2, geopolitics and supply chains. 3, Taiwan's irreplaceable hardware. 4, the A infrastructure pivot. And lastly, number 5, the Wall Street dilemma.
To really grasp why all of this matters, we have to start right at the epicenter, a mind-boggling $2 trillion target valuation. SpaceX is gearing up for an initial public offering, aiming to raise roughly $75 billion. Just to put that into perspective for a second, the current record for the world's absolute largest IPO belongs to Saudi Aramco, a massive legacy energy monopoly, and that came in at just over $25 billion. So SpaceX isn't just looking to beat that historic record, they're aiming to entirely obliterate it, becoming the highest valued IPO in the history of global capital markets.
And here is the sheer mechanical force of an IPO this size. It's not just about active investors choosing to buy in because they happen to believe in the vision. Because of NASDAQ's fast entry rule for megacap stocks, the very moment SpaceX lists, tens of billions of dollars in global passive capital and ETFs will be mathematically forced to buy the stock. When an index fund has to track a benchmark, it creates this automatic, undeniable tidal wave of capital flow, completely regardless of how the broader market is feeling on that given day.
Okay, moving into Section 1, the 2 trillion empire, a record-breaking IPO.
What's truly fascinating here is that SpaceX isn't going public because they're hurting for cash. Usually, companies need an IPO to survive or to pay down massive piles of debt. But look at SpaceX's current financial reality. They're projecting nearly $19 billion in merged revenue for 2025. Their satellite internet division, Starlink, brings in 61% of those total sales all on its own. And they're operating with massive 63% profit margins across a staggering 10 million global users. So this $75 billion fundraise isn't about mere survival. It is about unprecedented strategic leverage for the next phase of human infrastructure.
Which brings us to Section 2, Geopolitics and Supply Chains, the Southeast Asia Shift.
Due to explicit geopolitical risk assessments, SpaceX made a pretty heavy request recently. They asked their Taiwanese suppliers to relocate their manufacturing abroad. And, well, when a future $2 trillion giant speaks, the supply chain listens. This triggered a massive shockwave across Southeast Asia. In early 2024, Wistron New Web spun up Starlink production over in Vietnam. By April, Shenmao Technology was pouring millions of dollars into their own Vietnam units. And by late 2024 and heading right into 2025, huge legacy companies like Chinpoon and UMT are drastically expanding their footprints in Thailand and Vietnam. They are literally redrawing the global manufacturing map in real time.
But here's where we hit a really fascinating paradox that is absolutely critical to understand. If the overarching goal is to move out of Taiwan to avoid geopolitical risk entirely, why are SpaceX executives reportedly making highly secretive, low-profile visits right back to those exact same Taiwanese suppliers to discuss next-generation hardware upgrades?
Let's dive into Section 3 to answer that. Taiwan's irreplaceable hardware, the anchor.
The answer to that paradox lies in extreme technical thresholds. Honestly, surviving the vacuum of space requires such hyper-specialized engineering that SpaceX simply cannot abandon these partners. Take Compaq, for example. They command an incredible 70% of the entire low Earth orbit printed circuit board market. Or UMT, who provides the absolute purest space-grade radio frequency modules required for orbital communication. Then you have Molicel, manufacturing these top-tier lithium batteries capable of handling the insane thermal demands of a spacecraft. You just can't replicate this level of high-end precision overnight in some brand new factory.
And that dependency doesn't even stop in orbit. It extends firmly down to the ground. Taiwan commands a staggering $8.2 billion in ground equipment output. That's nearly 90% of the country's total satellite-related production. They absolutely dominate the physical terrestrial infrastructure. We're talking about the high-precision electronics, the massive antennas, and the coastal receivers right down here on Earth that are entirely necessary for these space-based networks to even function. Without this anchor on the ground, the orbital tech is basically useless.
Moving right along to Section 4, the AI infrastructure pivot, beyond low Earth orbit.
If you think this story is just about launching satellites to provide some rural internet, you are missing the hidden narrative here. The space race, it's merely the appetizer.
Yes, the low Earth orbit market is growing, and it's expected to hit about $2 billion by 2026. But the actual golden ticket for these tech suppliers? It's the explosive pivot toward artificial intelligence hardware. Just look at the massive jump in scale on this chart. The AI circuit board market is projected to completely skyrocket to $26.6 billion by 2027. That is where the real, transformational, exponential growth is sitting.
So to capture this massive AI market, suppliers like Compaq are making some huge capital expenditures. They're pouring roughly 10 billion NT dollars into a specialized technology called the MSAP process. Now, instead of traditional manufacturing methods that just etch copper away, MSAP carefully grows copper lines exactly where they're needed. This allows for incredibly fine, ultra-dense circuit boards that are fundamentally essential for power-hungry AI servers and high-speed optical modules.
And here is exactly where these two separate storylines violently collide. SpaceX isn't just facilitating AI development, they are fully merging with it. They've filed highly ambitious plans with the FCC to deploy up to 1 million orbital data center satellites. By leveraging the natural freezing temperatures of the vacuum of space to cool high-density servers and using the vast global reach of Starlink to transmit data back and forth, they are literally moving AI computing off-planet. Space isn't just a vacuum for communication beams anymore, it's fast becoming the ultimate super-chill data center.
Which brings us to our final point, Section 5, the Wall Street Dilemma. Tesla's fate. So this all leads to a fiercely debated dilemma that is actively dividing top fund managers right now. How exactly does a $2 trillion space IPO impact Elon Musk's other massive giant, Tesla? Well, Wall Street is completely split into two opposing hypotheses. Theory A is the double-handed strategy. This suggests bad news at Tesla is essentially being allowed to accumulate to keep its stock relatively cheap. Why? To pave the way for a heavily diluted stock-for-stock merger with a newly public SpaceX, a mechanical move that could help Musk legally regain 25% voting control for his broader AI development. On the other side, though, is Theory B, the magnetic effect. This camp argues the exact opposite. They state that a soaring SpaceX valuation will act as a magnet, physically pulling Tesla's value up alongside it, as investors realize both companies are deeply integrated into the exact same AI infrastructure.
Now, the reason both of these wildly different theories survive and are being argued by top analysts is because they rely on the exact same set of undeniable facts. Tesla is currently seeing rare negative free cash flow. Why is that? Because they are intentionally engaging in a record-breaking $25 billion capital expenditure right now. Furthermore, Tesla recently made a massive $2 billion equity investment directly into SpaceX, and the two companies are actually co-building a huge semiconductor foundry together down in Texas. It's a staggering all-in gamble playing out in real time across both balance sheets.
So how do you navigate all this? Simple. Ignore the internet noise and watch these three objective signals over the next 60 days. First, read the actual S1 prospectus the minute it drops. Look very closely at the voting rights and dilution clauses between the entities. Second, watch the actual IPO pricing in June. Does it truly hit that $2 trillion mark and trigger the mandatory passive fund buying we discussed earlier? And third, monitor the executive rhetoric. Pay really close attention to the frequency, the sentiment, and the overall tone of the news coming out of Tesla compared to historical norms.
Guys, we are watching a literal restructuring of global manufacturing, a profound pivot to space-based AI computing, and a Wall Street showdown of epic proportions. The mechanics are firmly in motion right now, but as the physical supply chain builds the orbital future, the ultimate question still remains. Who actually captures the trillion-dollar value back here on Earth? Keep your eyes on the data. Thank you so much for joining this explainer.